Welcome to Breeden Security Incorporated, Part B. So in this case, we're picking up where we left off. If you remember, the overhead application, the very last sentence in the last part, Part A, said that overhead was applied at the rate of $2 for every $1 in direct labor. And so that's what we're going to be focusing on in this case, is assessing whether or not that process, that technique that we're using to apply the overhead is appropriate. And as you read through this case, it very quickly becomes apparent that the controller, her name is Marlene Bayer, is concerned and has some doubts about whether or not that system is sophisticated enough to really pick up on the subtleties of the actual costs that are being incurred on a product line basis. And I want to encourage you that this is probably one of the hardest areas for companies to tackle, and it's always, if you have multiple product lines or even multiple divisions or regions in which you operate, and you're trying to figure out what those individual product lines cost your business, which is extremely important, you have to allocate some costs, and you've got to come up with a process for doing that. So we've talked briefly about product costs, direct materials, direct labor, and overhead. And two of the three, the materials and the labor, are easy to trace. We talked about that as traceable costs. So you can observe those costs and do time motion studies to figure out what the labor costs are that are being incurred on a per unit basis. Overhead is different, and that's what we're talking about here. Overhead are your blanket costs, the utility bill, the insurance bill, the property tax bill, the maintenance, the repairs, the janitorial services, supervisory costs that oversee processes, your administrative costs that oversee the operations. There's all kinds of other costs that are incurred that are considered overhead. Remember earlier I talked to you about distinguishing between manufacturing overhead and SG&A or other operating types of overhead. And so we're still making that distinction here. But when you talk about allocating to product lines, you're talking about allocating manufacturing overhead costs only. Okay, so generally that's what we'll be focusing on when we talk about allocating product costs. Other times you'll be allocating not only those costs, but allocating SG&A. And that often happens when you get down to the division level. And we'll talk more about that when we get to budgeting and we look at responsibility centers and the like. But right now we're focusing on these product costs and the manufacturing overhead that's incurred. So what she does, I won't tease you on this. It is a fairly complex case. There's a lot of numbers here and things for you to look at and work through. Very challenging, but worth it, worth every minute of your time to try to understand and unravel what's going on in this case, because it's a very common problem. So what she decides to do is take what's in that overhead, remember that's in a total pool, and break it down into smaller pools. So take it and allocate it down so that she can be more specific about how she's allocating those various pools based on different cost drivers. So as it stands right now, we have one pool and one cost driver. The cost driver is the direct labor. So you got to get your mind wrapped around some of the terminology we use when we talk about overhead application as well. So things like cost pools, cost drivers, activity-based costing versus traditional costing. So I'm going to talk a little bit about that. All right, so that's where you're going. You're going to reassess how overhead is allocated. And when you get done, you're going to decide whether or not this new information you have, one, is better. Now here's often mistakes that I see students, they fall into this trap. When they look at the end result after you get done, they misunderstand that what you're doing is taking a pie, a total amount of costs, and you're not increasing the amount of costs and you're not decreasing the amount of costs, you're divvying it up differently. You're spreading it out differently to the two product lines. Okay, so it's not like you're improving efficiency, you're improving accuracy in how those costs are being allocated. So you got to make sure you remember that. That's one area in which students oftentimes will get tripped up. And then Other times, too, I'll see students say, that if we decrease the price on that product line, then we're not going to make as much money on that. And what they're failing to recognize is that elasticity plays a part there. And I'm going to talk more about that when we get to the tail end of the video, too. All right, so those are some of the things just to kind of watch out for in terms of your critical thinking and understanding how to apply all the things that you've been learning in your program. All right, so as I mentioned, Bayer didn't think that direct labor was a good predictor of the amount of overhead that should be charged to the products. And there's your formula there that we had been given in the previous case, that they were taking total budgeted manufacturing overhead and dividing it by budgeted total direct labor dollars, and they came up with a ratio of 2 to 1. So they would apply $2 of overhead for every $1 of labor. And if you look at the exhibit, which I think is on page 52, exhibit 1, it's the same exhibit you had before. You'll notice in the middle of the page where the overhead is listed with the little A after it, that's exactly what's going on. RC1 is 70 grand, where the labor is 35 grand, so it's 2 times the labor. And RC2 is also 2 times the labor. So they're applying overhead at the same rate, using the same system to both product lines, just double the labor. And you also notice that overhead is the biggest of the 3 individual components, so it's a significant portion of the total cost. And so it's extremely important that we get the allocation of those costs correctly, because it is such an important part of the total cost. All right, so this accuracy is extremely important, not just for pricing decisions, which is all by itself good enough reason to make sure that you allocate properly so you get the right price, you set the right prices. But also, let's say you're trying to evaluate a manager of a particular product line and you haven't allocated the cost properly. It would be considered unfair. And most managers are smart enough to figure out very quickly that that's the case, that the overhead is being allocated in an arbitrary fashion and it doesn't reflect what's really happening. And they get very antsy about it if they're getting compensated based on the performance of their operation and they're being allocated costs that they can't control. So it's extremely important to get it right. So not only for product lines, but for divisions or regions or customers even. And we'll look at a case here in the next case, we'll look at customers specifically and do the same kind of analysis where we're allocating costs to the customers to see who is our most profitable customer and what should we be pricing, right? Our customers. All right, so other things that make this very important is that the consumption are different. And she talks about that in the case where the packaging and shipping operation has increased in its costs significantly, and it's totally because of the RC2 product and the way that they're selling it. So that's definitely happening in this case. And then the third thing here, the traditional methods are okay when your process is super simple or when you only have one product line. But if you've got a lot of product diversity and there's costs that are being incurred for a product line that differs from other product lines, then it's extremely important that you're careful, because you'll end up with what's called cost distortion. Right? So I'll talk about that. It matters, right? Because you want to make sure your product lines are giving you the right profitability picture. It matters because you're going to make decisions about whether you continue or discontinue and what your prices are. And it matters because you create cost distortions, and managers of those various operations will question your credibility if you don't take steps to make sure that the overhead is allocated properly. So how do we make sure it's done properly? And the key thing is to add more specificity, more sophistication to the process in which we're using to allocate the overhead. So we'll take that total bucket. Let me go back to that one slide real quick. This one. We'll take this bucket right here and we'll break it down. Now, I want to emphasize too, we got to be careful here. If you get too much specificity and you go too wide on this, then you end up creating so much work because you got to track every single cost driver that you choose. So every bucket that you create, you've got to track for each product line how much is being consumed by the various product lines in actuality. So it's beyond budgeting, you've got to also track during the year. I remember one time I had a student who worked at General Motors, and he said they used activity-based costing there. And at that time, he said they were trying to shrink the number of cost pools they had. If I remember, he said they had well over 100 different cost pools, and that's just unwieldy to manage. So in your case, she's developed, her idea is to create 5, and then as you work your way through the case, you get into the middle of it, she ends up taking one of those and decides that it's not meaningful by itself. I'm going to allocate it to the various operations because that's where it occurs, and it's the quality control piece. So she ends up back fleshing it across fabrication, assembly, and packaging and shipping, so across the processes that exist within the business. Okay, so adding specificity, defining more buckets, making more buckets. And what we do there is we take and we look at the costs and we try to group them into meaningful groups. So we look at like costs, we try to pull them together and create these cost pools. And we can do that in multiple ways. We can do it by department, we can do it by process, we can do it by activity, we can do it by area. Like, the sky's the limit. There's no right or wrong way to set up these cost pools. It's just what's meaningful for you. And as you read through the case, you'll notice she says things like that. Like, part of what drove her to choose what she chose, remember these are real cases, was because, if you look at the bottom of page 46, it would be easiest to get. So she recognizes that sometimes, you make choices based on the data that you have available. And obviously that's going to impact your strategic advantage, your strategic competitiveness. So you do want to have as much data as you can get your hands on in your organization to make the best decisions you can. And then she'd have to find the highest correlating cost driver she can for each pool. I had my undergraduate students do a project where I asked them to figure out what is the best cost driver for a particular cost. So what has the highest correlation? And I have them do some regression analysis on that to figure that out. So when you do this and you create all these cost pools, we call that activity-based costing because we're actually creating the pools based on what's going on. Okay, here's the core learning objectives for this case. So making sure you understand some of those terms I'm using. What's a cost pool? What's a cost driver? What's activity-based costing? What's a traditional costing technique? And then getting you to compute those rates. So I have you walk through that process of computing those rates. And then assessing the impact on profitability when you, for each product line, when you change up how you're allocating the overhead. And then recommending a strategy for them moving forward based on what you learned. All right, so let's read through this. It's actually a really good summary that I created for you here. So Marlene Baer, she's the controller, recognizes that grouping all the manufacturing overhead costs together and allocating them to 2 product lines is not very accurate. So instead, she groups overhead costs by activity and then allocates them to the 2 products. Let's start right there for a second. On page 46. You see she references fabrication, so near the bottom of the page. Fabrication is going to be one of them. Assembly is another. Packing and shipping is a third. And then you read down the last paragraph on page 46, she talks about 2 more, quality control in general. So she's going from 1 to 5, and then she backs down, and she ends up using only 4 of those. And I want you to notice too, so maybe in your presentation, because I don't really have you address it in that case, but in your presentation, notice the general operations on page 53 is actually the biggest pool, and she ends up, realizing that there's probably costs that are in there that need to be grouped. So she probably will end up, after she gets some level of sophistication going here, obviously what she's doing here is going to create big change. So there's even more work to do on that general operations pool because there's probably still too many costs that are in there that need to be regrouped. And again, the way you do that is by looking for similarities in those costs. Okay. The system resembles a simple activity-based costing and introduces the definition of activities, costing those activities, and computing product costs based on their use of the activities. The revised product costs are considerably different, and analyzing what causes the differences is important to discovering where activity-based costing can provide valuable information. So in addition, at the end of the year, profits have been reduced by the need to take care of a growing and increasingly complex packing and shipping activity. Bayer defines a new activity, computes the cost per order, and begins to revise the data on product profitability and develop data on customer profitability. Having discovered the high cost of handling each order, the controller now has good reason to work on activity-based management and the notion of customer profitability, making that process more efficient, perhaps more customer-friendly. So there is the additional benefit that I didn't tell you earlier when I defined the benefits. When you get into this and you start picking away at what's driving costs in our organizations, you start seeing some severe inefficiencies emerge or problem areas. And now that you're armed with the tools you need, with the cost data that you need to be able to explain this and maybe manage it a little bit better, you're going to be able to drive value in your organization. Okay. So this was one of the questions in your case. It's actually the first question, is what are the benefits of moving to an activity-based costing? When would you do it? And it's absolutely beneficial if you've got a lot of product line diversity, which we do have in this case. It's also beneficial when overhead is high, and we saw that earlier. I mentioned that too. The overhead is the biggest of the three components in the cost of direct labor, direct materials, and overhead. And when strategy is extremely important. So for this company, they're in a highly competitive marketplace. Electronics and the prices are very sensitive. So yes, pricing is important to strategy. Okay, so you're going to notice that we first work on a 3-pool ABC system, and then I have you go to a 4th pool. So I have you add that extra step in. And you're going to notice that the costs do shift away from R1 to R2, which gives you the opportunity to drop the price you're charging on RC1 because your margins will still be there. And I have you play around with that on one of the tabs of the template and calculate the margins that you have on the product lines given these shifts of cost and what prices you should charge to maintain the original margins you had to start. So that'll be a really good lesson too. And then I want to also kind of talk about this elasticity thing I alluded to earlier, because students often make this mistake. They'll say if you decrease the price, you're going to lose money. That's not a good idea to decrease the price. When they miss the whole point, the point is you're making more money because you're dealing with a product line that has elasticity. Meaning, if you drop the price, you're going to get a bigger change in volume. So you're going to sell more units. So your revenue is actually going to go up if you drop the price. Right? You're going to sell more units. So maybe the margin on that is a little bit different. But because your costs are being allocated differently, you should be able to maintain your margins. It's just going to shift the way things are accounted for because of the way you're allocating the costs. But in total, you're still in the same place. You're just being more competitive because you have better information. And then if you have an inelastic product like the RC2 is fairly innovative, new type of product line, you can get away with a little bit more. Meaning, if you increase price, not huge increases, but if you do shift your price up and it's inelastic, you should experience less change in volume, meaning that your revenue will go up, because your percentage change in price exceeds the percentage drop in volume as a result of increasing your price. So total revenue should go up. You're getting more on a per unit basis. It makes a difference. So you got to take that into account when you make these types of recommendations, is the elasticity. Okay, that's all I have to say for now. Give it a go, and let me know if you have any questions.